Welcome back to the channel, everyone. Today, we're diving deep into a topic that's crucial for both seasoned investors and those just starting their financial journey: government bonds versus corporate bonds. As a financial expert, it's my mission to provide you with clear insights that will help you make informed decisions. Both of these options have their own unique features, risks, and potential rewards, so let's explore them together. First off, let's talk about liquidity. When we refer to liquidity in the context of bonds, we're discussing how easily they can be bought or sold in the market without significantly affecting their price. Government bonds, particularly U.S. Treasury bonds, are often considered one of the most liquid assets available. They have a vast market, meaning there are plenty of buyers and sellers ready to trade. This is especially important if you might need access to your funds in a pinch. On the other hand, corporate bonds can vary widely in terms of liquidity. Larger corporations typically issue bonds that are more liquid than those from smaller firms. However, smaller or less well-known companies may not have as many active buyers in the market, which could lead to difficulties in selling the bond quickly without incurring a loss. So when considering liquidity, think about your investment horizon and whether you might need to access your money at some point. Next up is accessibility. For many investors, government bonds can be easier to purchase directly through platforms like Treasury Direct. They also often have lower minimum investment thresholds than corporate bonds, which can require larger amounts upfront, especially for high-quality issues. However, investing in corporate bonds often comes through brokers or mutual funds, which can add an extra layer of complexity. The accessibility factor really depends on how comfortable you feel navigating these platforms and whether you're willing to do your homework on individual corporate issuers. Now let's move on to profitability. Generally speaking, corporate bonds tend to offer higher yields compared to government bonds. This is primarily due to the additional risk involved. Investors demand a higher return for taking on that risk. If you're looking for income generation and are willing to accept some level of risk associated with corporate performance and creditworthiness, then corporate bonds might be appealing. However, higher profitability comes with its own set of considerations. Government bonds usually yield lower returns because they are backed by the government and thus deemed much safer investments. In uncertain economic times or during market volatility, many investors flock to government securities for the security they offer, even if it means sacrificing some potential yield. It raises a critical question: how much risk are you willing to take for the sake of potential returns? Let's not overlook risk management here. Government bonds are often considered virtually risk-free because they are backed by the full faith and credit of the issuing government. In contrast, corporate bonds carry varying levels of credit risk depending on the issuing company's financial health and market conditions. High-yield or junk bonds offer enticing returns but come with significant risks of default. It's essential to assess your risk tolerance before making decisions between these two types of investments. Now on to psychological factors, an aspect that is often underestimated in investing decisions. Many investors find comfort in government bonds due to their stability and predictability. This psychological safety can be invaluable during turbulent times in the market when fear and uncertainty abound. Conversely, corporate bonds might appeal more to those with a higher risk appetite, who enjoy analyzing companies' financial statements and staying updated on market trends. The thrill of chasing higher yields can create excitement, but can also lead to emotional decision-making that may not align with long-term investment goals. As we wrap up this comparison between government bonds and corporate bonds, it's clear that both options come with their own set of advantages and disadvantages, making it essential for you as an investor to reflect carefully on your personal financial situation, investment goals, and risk tolerance. So, what do you think? Are you leaning toward the safety of government bonds or enticed by the potentially higher returns from corporate bonds? I encourage you to share your thoughts in the comments below. Let's engage in a meaningful discussion about these investment options. Your insights could help others in our community make better financial decisions too. Don't forget to hit that like button if you found this comparison helpful, and subscribe for more financial insights. Until next time.